Hello traders, so I just wanted to go over TradingView's new feature, which is the options strategy tester, strategy builder. And I wanted to just talk about how to read the chart. So we're not going to go into all the strategies in this video. Those can come later. What I want to get you guys comfortable with is, if you haven't ever used one of these, how to read the chart and figure out what it's going to tell you want to know. So you can see in the background, we have SPY, the 5-minute chart up, and you can see that the price on SPY right now is trading at about 605.13. Okay. So when we're building our option strategy, we can see here that we have our price on SPY all the way from 545 to 665. So the lower line, the x-axis, is going to be our price of our underlying asset. Okay. And then on this side of things, we can see different things. So in this situation, we're looking at expiration February 21st. So that's going to be a Friday expiry. And you can see that you could pick any expiration you want for what you're trying to build with that strategy. So if you wanted to be looking at a strategy of 0 days, you're looking at this. And then if you wanted to look at a strategy a couple of weeks out to give you a bit more time, you're looking at this. So the next thing that you're going to watch is what kind of play you're setting. So in this case, we just have activated the very most basic thing that you could do, which is a long call, which means we are buying a call with the expectation that SPY is going to go up. And then the strike price is, of course, the strike that we're buying that right for. So that's going to be 605. That's going to be listed here. And you can see that you could buy any you could choose it for any strike you want. You can go crazy out of the money, and you can see that that will change the slope of all the lines in the chart, and we'll show you why pretty soon. Size is 1, so that's how many options we're going to buy. So we're going to buy, in this case, 1 option. And then the Greek actually, so the Greek is always going to be shown in this orange here, and the Greek allows you to choose what you want to be told. So if you look through the Greeks, we have delta, gamma, rho, theta, vega. So delta is going to be our sort of most basic, because delta measures the underlying move, which basically tells us how much our option is going to move, right? So the delta is measured as for every $1 move of our underlying. So from SPY, in this case, moving from 605 to 606, then we know that our delta is going to move with it. So if we go right here to our current price where we're trading, right? Then at 605, 604, 605, there's our underlying price. We can see that the delta there is 50. And what that means is that if for every move that SPY moves up $1, our option is going to move up 50 cents. Okay, so here when we see the max loss, that's essentially when we're trading a straight call. So what's nice about this is that it's going to show us all the different things. So it's going to show us that our max profit is infinite. And that's because when we're buying a straight call, the more SPY goes up, the more money we're going to make. So there's no cap on how much we could possibly earn. Whereas when you get into the strategies below, there's a cap on a lot of them. If you're doing spreads and stuff like that, there's limits to how much you can earn with those. So in this situation, when you're doing a straight call or straight put, there's unlimited amounts that you can make from it. Okay, so what else do we see here? So when we're looking at the max loss for a straight call, it means that basically that's basically the price of the option. So the price of the option is probably going to be $5.45, which is $545 because we are multiplying it always by 100 shares, right? So we have here that we're trading at our underlying of 605. Our max loss in this situation is going to be covered here. That's the price of the option in this case. It shows us the win rate of this strategy. So the win rate of buying the straight call in this situation is about 33%. And then if we look at the chart, we can see, so it shows you that the red line, you can see here, the red line says your expiration P&L. So what that means is that when we reach February 14th, based on where we are on the SPY chart, that will tell you what your P&L will be. So you can imagine that anything that's below what we're trading at right now when you bought it at 605, because that's our strike, right? So anything that's going to be below our strike is going to be maximum loss, because at expiry, the 605 is going to expire at 0 at anything under 605. So that's showing you that, so you're going to be your max loss. Now, because the option costs $5 or 500, it's priced at $5 times 100 shares. That means that your break-even price, which means you need SPY by expiry in order to break even on this, to move up that difference. So that's going to be your break-even price, 610.46, which means that anything between here and there is going to give you partial, because if SPY closes, on February 14th at 607, that option that you paid $5.45 for is now only worth, with the underlying asset being worth it, it's only worth $2. So if we close at 607, so you can see here I go to underlying at 607, and you can see that your expiration P&L will be minus $345, and that's because you'll have the $2 of the underlying price. So that's what you read it here. So on this line here, it shows you your zero break-even price. And then above it, it shows you what your profit would be at any price if we expire. So you can see that just as soon as we go over 610, anything above that is going to be profit. So if we close at 615, of course, you'll have $454 of profit because you're above that 610. And then the delta price is going to be changing as well. And that's because the farther that we get towards a delta of 1, it will stop moving. So what that means is the more in the money you get, the closer to 1 you'll move, 1 for 1, because you can imagine that once we're over 610, you start to be at the point where the more it moves to the upside, the more your option has to move to match it, because you're moving considerably away from the amount of premium versus the amount of underlying asset that you actually own. You're moving towards more underlying asset versus premium, and that's going to make your delta continue up until it eventually reaches 1. And you can see it flatlines just around here where you basically have no more premium. It's all implied price, and that's going to be right up at that 630 area. And then the same thing to the downside. Eventually, the delta, if you keep moving away from it, is going to get closer and closer and closer to 0, because it would take so much movement. You would need if you get all the way down to 560 on SPY, the amount that you would need for the stock to move to break even again would be so massive that it's not going to cause any big volatility. So if you're trading here at 605 and you make a large move down, your delta, instead of moving at 50 cents for the dollar, you can understand why it's only going to move 5 or 6 cents, because the chance of your call doing well at that point becomes lower and lower and lower and lower. So that's what we're looking at there. And then the blue dashed line is going to show you your current profit and loss. And so basically what that's showing you is, now, instead of waiting till expiry, so we know expiry, you can go 0, you can go between here, and then you can sort of just go straight up between there. Between now and expiry, there's going to be different prices because of the different Greeks. So this is going to show you, if right at this minute we were trading this level, this is where your profit and loss would be. And that is the one that can change over time. But now we're going to watch it. And you can see that's why it kind of slopes a little bit down until it approaches 0, slopes a little bit up until it approaches the exact line of your goal. So you can see that when you go to a shorter expiry strike, right, these lines are going to become far more steep because you have a lot less time to get there. So it's basically, this is your break even. Obviously, this would mean a $60 move in one day, probably not going to happen. So you can probably try to resize that for shorter. So you can zoom around the chart a little bit to give yourself a better view here. So if we're playing 0-day expiries and we know we're probably going to be trading within a range, here's what we could do right now. We could say, okay, SPY is trading at an underlying of 604.90 still. And there's our underlying, and then this is how the delta would move. It's a much straighter line because you're so close to in the money. This is how our current profit and loss would move. You could see how quickly it falls off. And then this is where our break even would be, because the underlying price is $1.13. So our break even is going to be $1.13 higher than we're trading now. And then anything above that would be our profit. Anything expiring in between that by the end of the day would be in between. And anything under 605 would be our max loss. So that's going to be our most basic strategy of how we cover how to read these charts. And then we'll try to check back in and go through some of the vast options of option spreads that we can start to build off of this strategy builder.